Hi, good morning everyone.
Morning.
Okay, I think it was 2 months ago since we last had a press conference, and I think there's a lot of changes that has happened over the last 2 months. And I think these are all positive changes. And I think most of you were here, and I think we were a bit gloomy on our outlook 2 months ago. But there are signs at the moment that are indicating that we may be off to a good start for 2019. Okay? So, just probably give an overview first of what are the positives and negatives that we're seeing. And probably most of are still the same from what we've pointed out 2 months ago. Let's start with the positives. Again, the central agency is really the BSP. And last 2 months ago, the BSP has started to become very hawkish on and very aggressive on adjusting their policy rates. And this has dramatically changed, number one, the view of foreign investors over how the BSP can take control again of the inflation, the worsening inflation in the country. And they became hawkish. They were able to hike rates aggressively. And right now it's 4.75 overnight rate. Inflation was the key theme 2 months ago. And now we've been getting some indications that it has been slowing down, or it has even already peaked, probably. Whereas 2 months ago, we were saying that this peak of inflation might be pushed forward to first quarter 2019, but I think the government has started to make a lot of measures to address the rice shortage, and more so, oil prices, which I'll talk about later. And then, one key thing that has been progressing is the train tour, the Trabajo Law, and we're quite excited about the prospects of this. But the only thing that's being debated now is if they will include excise taxes on gas or not. So on this new law that will come by next year. Some of the negatives, okay, we've been seeing equity markets move higher because of overall positive sentiment. However, if you go and look at each of the companies that comprise the index, in order for the rally to be sustainable is we need to have earnings. But unfortunately, we've been getting, as of third quarter, earnings are not as exciting as what we've predicted during the first part of the year. In fact, we've been getting a lot of earnings downgrades across the industry from the different analysts. And if we see a lot of earnings downgrades, then it would be difficult for any market rally to be sustainable. So hopefully we can see earnings to turn around starting next year. And then the US continues to hike, but pronouncements last week of the Fed by Fed Chairman Powell been saying that, or giving indications that they may already be approaching the neutral rate. What does it mean? It means that they may see rates stabilizing soon. So that was taken positive by the market. But it doesn't mean that they will stop hiking. I think they will continue their projected Fed rate hikes. I think everybody's expecting one coming this December, and another probably 2 or 3 next year. But at least, he's already indicating that they may already slow down. Okay? But going back domestically, I think our balance sheet continues to, the government's balance sheet rather, in terms of the current account, is still something that we are watching closely. And this, the government continues to push with their build program, then definitely we will have to import more, and then this current account deficit might balloon further, which again won't be taken in the short term positively. Okay, so at least this is the overview. Nothing really big on the negatives, but on the positives, there have been some turnaround stories already, especially on inflation. Okay, going to the U.S. The U.S. economy continues to be strong, and that's why the Fed has been on track with their adjustment on policy rates. This chart shows you the dark yellow are the total unemployed workers. It's going down, and then the lighter line shows you the jobs being created. So clearly, the U.S. labor market is becoming healthier. That's why it's fueling the growth of their economy. And we have been seeing that because of this, we have seen the market in the U.S. rally significantly, and at the same time, the Fed has been able to adjust rates higher in order to be ahead of the curve and to combat inflation, and at the same time balancing growth versus how they would want to bring up and normalize their rates. Because remember, they started from zero. So they need to normalize rates in order for the economy not to implode. Okay, oil. This is a big turnaround since 2 months ago rather, where we have been seeing that there's a lot of pressure on the global market for oil prices to move higher. But suddenly, what happened? Why are we experiencing consecutive weeks of oil price rollbacks? And again, there's one more, I heard tomorrow, a big rollback again tomorrow. So clearly, those are the ones that we're feeling. And the story behind that is apparently Saudi admitted that there has been an oversupply of oil in the global oil market. There's an oil supply glut happening at the moment. That's why the OPEC members have been trying to meet and try to cut down production. Not because to bring up oil prices again, but more so because they don't want to maintain a supply overhang or a supply glut from worsening. And the other part of this is the US. The US has been addressing the concerns on their shale oil. Because previously, shale was the one that has been preventing WTI and Brent from shooting up above 100. But when oil prices shot up, where was shale? The problem in the shale market is that they could not transport the supply. There were no infrastructure to address that supply bottleneck in the US. And they're trying to address that. And hopefully by next year, that can add more supply in the US, thereby adding to the supply of the global oil market. So we can expect oil prices to be at least below 70 for a sustainable amount of time, and probably moving into 2020 even lower, as we see global economy starting to slow down, headed by China. And we still don't know how the trade war will really impact China and the US. Okay? So inflation, again, from the peak of 6.7% in September, we have been seeing inflation adjusting lower. Tomorrow, they will announce the November inflation figure. Our expectation is about 6.3% for November. This is within consensus. And more so, the important thing on that is the direction of inflation. We're seeing inflation already slowing down, and in fact, probably has already peaked. And this is a change from our previous forecast where we saw inflation worsening probably towards December, but because of what happened in world oil prices, it was able to help us recover inflation faster. So hopefully if we continue to see oil prices going down, then probably our own inflation will really normalize already and hit the 2 to 4% target of the BSP for next year. And the other thing that is crucial here is the government has already passed the rice tariffication bill. So I think it's up for signing, if I'm not mistaken, by the president. So if that happens, then that will also address that near-term supply bottleneck that helped shoot up inflation last September. So if inflation normalizes, and again, this has been the culprit of higher interest rates and lower equity markets in the country, so we might probably see a better financial market outlook for next year. Okay, speaking of interest rates, okay, and we have seen the BSP quite aggressive with their overnight rate, from 3% to 4.75, 2.75% adjustment. And this, we haven't seen this aggressive stance of the BSP probably in the last 10 years or so. And as of late, we have seen the yield curve of the government securities also react positively to this lower oil prices and lower inflation. And we've seen the 5-year rate and the 10-year rate go down significantly by 100 basis points at least. Recent auctions has indicated that 5-year, probably a month ago, hit 8%. 8% rate for a 5-year government paper. But as of the recent auction, the 5-year went down to about 6.9%. So, for one, there are a lot of takers for government securities because they think, or investors think that we won't see rates moving up beyond 8% because indications show that inflation has already been addressed. And at the same time, the government has been quite aggressive, or the BSP is quite aggressive in really addressing inflation fears. So the whole market reacted positively and started buying bonds. And that has helped a lot of corporations start looking at pricing for their loans. And it's quite important for us, the economy of the country, to really have not high rates but more manageable rates in order for companies to continue to borrow cheaper to fund their expansion. So again, that's something positive, and we expect the yield curve overall to continue to go lower as inflation continues to go down. So that's both positive on the fixed income and more so on equities, because previously, if you have a 5-year government paper that's yielding you 7 to 8%, a lot of investors have moved towards looking at bonds more than equities. That's why now, as rates starting to go down again from the initial spike that they had over probably a quarter, now we can see the refocus of investors towards the Philippine equity market. Okay? Then moving on to the currency. Even 2 months ago, we've seen that the peso was trading at 53.50 thereabouts. Now, it's at 52.40. Almost more than 1 peso appreciation. Again, there's a lot of factors that affected the sudden appreciation of the peso. For one, foreign funds coming back in to the market. Foreign funds starting to buy not equities but fixed income. That's why we have seen a demand for fixed income or bonds bringing down yields. And the other part of this is the view of foreign investors now is the peso will be more stable moving forward. That's why the hesitation before to invest locally and exchange their dollars to peso was not there. But now, because of the hawkish stance of the central bank, the BSP, as well as rates starting to go down, they think that the peso will start to stabilize. Thereby, it's safer for them to start buying government securities first, and I wouldn't be surprised if they start looking at equity markets after this. So, with the mix of foreign buying coming in and seasonality that OFW remittances starting to come in, we might expect the exchange rate to hover around these levels, moving on to probably first few months of next year. Okay, so clearly there's a big change and appreciation of the peso against the US dollar, and this has really affected positively the economy of the country. Okay, so again, we expect it to really be stronger in the next few months or so, given the factors that I mentioned a while ago. And again, I'm banking on the fact that we might see a resurgence of foreign funds coming in as the refocus from developed markets moving into emerging markets. And we've seen that trend coming into Indonesia. Hopefully, we can see that trend moving into the Philippines as well. A lot of foreign investors are now assessing their positions on developed markets because, as you see, funds usually just do switching from in terms of relative value. A lot has already been gained in developed markets. In the meantime, emerging markets continue to trade very cheap, including the Philippines. And in fact, the Philippines was once one of the worst performing equity markets this year. But now, it has recovered from a low of about 6,800 or 6,700. Now it's trading at 7,500 today. So clearly there's a lot of changes, and this is happening very fast in the market at the moment. And a lot of it has to do with flow of foreign funds coming back into the country. Okay, in terms of our view on growth for next year, well, we continue to expect strong GDP growth. For this year, we expect GDP to probably to average about 6.1%. This has been adjusted because of slower consumption because of inflation adjustments. But next year, we expect the economy to grow at about 6.4%. This will be fueled by the first half midterm election spending. We expect it to fuel consumption growth, which has tapered off a bit this year because of higher inflation. But next year, we're quite optimistic that consumption-led growth will start to move up again, together with the aggressive stance of the government in its Build program. And we expect this to materialize after the elections, because remember, there's a blackout period from I think from November until election, that there won't be any new contracts. So after May, we expect it to continue and in fact accelerate as the midterm election has been decided. So with government spending and the resumption of strong consumption growth with lower inflation, we expect GDP to continue to fuel the growth of the consumption, and government spending to fuel the growth of GDP for next year. And we're more aggressive for our 2020 target, as we expect hopefully to see a 7% GDP growth by 2020. And this is again a confluence